Hello, everyone, and welcome to Eventide's quarterly CIO call for the third quarter of 2026. We're thrilled to be here with you today. Dr. Finney Corvella, a founding member of Eventide and one of our two co-CIOs, will be sharing about what happened in the second quarter and our perspective as we enter the third. He is an eloquent speaker and adept at presenting a thoughtful understanding of the market that focuses on the most salient trends and events. Before we begin today, I do want to cover some important information. This communication is for informational purposes only. The opinions expressed in this CIO call are subject to change and are not intended as buy or sell advice. You can subscribe to stay informed at eventideinvestments.com/subscribe. And in case you want to review these slides in the future, they will be emailed to you directly after the conclusion of this call. You can also access them at eventideinvestments.com/CIO replay. With that, I'll turn it over to you, Finney.
Hey, thanks, Fred, and thanks everyone for joining. Hope everyone's having a great summer. As always, I like to start with just general macroeconomic and market updates. So where are we now? We are at a place where the S&P 500 has now shrugged off Iran war fears. What we saw earlier was this decline in the end of the third quarter where lots of fears were building. However, we had a very significant move out of that, and now the S&P is up roughly 10% year to date, despite a lot of headwinds that you might have thought would have inhibited the market. The story of why the S&P has done so well is, in one word, earnings. Earnings have done remarkably well. And what this graph is showing is it's a bar chart that shows NTM earnings. NTM stands for next 12-month earnings. And you can see how the S&P has done. And then this orange line here is showing the year-over-year growth rate. And notice here how well the S&P has done just in the first and second quarter of 2026 with these monster numbers growing in the mid-teens and even over 20% earnings growth year over year. That's very, very impressive, and the primary reason for the S&P just barreling through and making the kinds of highs that it's been doing. Now, it's not all rosy. We know that the other big story that we've been watching and paying careful attention to is inflation. There's two ways of measuring inflation: the CPI inflation and then the PCE inflation. The PCE is how the Fed prefers to look at inflation. And one of the things that we see is just in the last few months, we've seen that both core PCE, which is shown in yellow, and then blue is headline PCE. Those have gone up. Now, especially the blue one makes a lot of sense because, of course, the price of oil and thus gasoline has moved higher. That's why this move is more pronounced. But you can see even in the core component, which means without food and without energy, so it's housing, it's services, you can see that that's been grinding higher as well. And so this has been something that the new Fed chairman, Kevin Warsh, has been very concerned with. And in his first speech, he came out very hawkish, saying, I'm going to do whatever it takes to drive down this inflation to get it closer into the twos rather than in the threes where it is right now. And not surprisingly, the 10-year yield has been moving higher. The 10-year yield is this number where the bond market says, I'm going to give higher interest rates if inflation is higher as a way to compensate for that inflation eating into returns. And so you can see now we're about at 4.6, so quite a significant move just in the last year as interest rates have moved higher. And normally you would think that this is punitive and a headwind for the market. However, just because earnings have done so well, the market has done well despite the higher 10-year yield. Now, let's use our three legs of the stool approach to say, okay, that's what the market has done. What's it going to do? And how can we understand the risks of the market and how to position our portfolios accordingly? And for those of you who are new, the three legs of the stool is an approach that we've used for many years where we look at leading indicators, valuation, and sentiment. And so we're going to go in reverse order, starting with sentiment. Each of these has power to help us understand the economy as a whole and the markets. And when we use them in combination, we can get even more confidence in making decisions about our allocation. So let's start with sentiment. This is the indicator that we look at most frequently. This looks at the sell side and how much they're saying to allocate into equities. And so these would be firms like JP Morgan and Morgan Stanley and Goldman Sachs. And they give recommendations to their clients about how much to put into stocks. And interestingly, if you take the whole of the sell side and average them together, you find that you actually want to be doing the opposite of what they're saying. So when they're saying to put a lot into stocks, that's actually bearish. It's a contrarian indicator. When they're saying to not put money into stocks, that's actually when you want to be investing into stocks. And so paradoxically, you want to do the opposite here. So where are we now? We are right kind of in this neutral zone. So the red and the green are plus and minus 1 standard deviation about the mean. And you can see we're getting close to that bullish line, which is, again, paradoxically bearish for stocks. So we're going to score this neutral, but drifting higher and not super happy with that trend. People are getting more complacent, more excited, and in general, sentiment is not where we like it to be, where people are really afraid. So as I said, we're going to score this neutral, but with a negative tilt. Now, let's go to valuation next. This is a great table. It's very handy. It shows the S&P 500 over a wide variety of just really standard metrics. Things like trailing price to earnings, forward price to earnings, price to book value, EV to EBITDA, price to cash flow, enterprise value to sales, where we are currently, and then the next column is the average, and then are we above or below the average, and then how much history generated that average. And whoa, look at these numbers. They're really big and high, and that's kind of scary. That means we are way more expensive than the historic average for the S&P 500. So this should give you some caution, and in general, it should make you think, I got to be really careful here when valuations are this elevated. Now, we can take some solace in that when you compare the S&P to fixed income, and so basically comparing across asset classes, and particularly this ERP market base, I've explained this in the past, the details, I won't get into it now, but you can see at least relative to bonds, it's roughly at fair value. So that would suggest that the S&P is expensive relative to its own history, but not crazy relative to bonds. So at least there's a little bit of solace we can take in that. These are just the definitions of those metrics that I covered before. Now, small caps look better. Small caps, thankfully, are, at least right now, priced by the market to be much closer to the historic average. So when we looked at the S&P 500, we saw numbers like 80% higher, 90% higher. And here, it's the same table, and you'll notice 12%, 11%, more modest numbers in general. And so we can appreciate and say, you know what, small caps, at least right now, are priced much closer to the historic averages. And this is one of the reasons why small caps have been doing better than large caps year to date. And we continue to think that that's an interesting story that we should be paying attention to as investors. Now, what this chart is showing here is looking at correlations. And basically correlations are where if correlations are high, that means everything's doing the same thing. Everything's going up together or going down together. When this is low, and you can see right now, it's very low, that means that there's dispersion and stocks are doing their own thing. And one stock might be doing one thing, another one is doing another, and they're disconnected. And that's a good thing. And it's a good thing, especially for people who are stock pickers or who like active management. And so in general, this kind of environment is favorable for active managers, and we believe this is a great time for people to consider their active allocations given this low correlation environment. Okay, so we're going to score valuations as mixed because, as I said, for a large cap, they look pretty expensive relative to themselves. Although, like I said, there's an asterisk there that relative to bonds, it's not crazy. Small caps do look much more in line with historic numbers. And so we'll say that there's some nuance that we want to apply to the valuation framework. Now, let's talk about leading indicators. Leading indicators are really powerful to help us know where the economy is going, where the market is going. This is the granddaddy of all of the leading economic indicators. It's called the LEI. It comes out every month. It's published right here in Cambridge, Massachusetts by a nonprofit, nonpartisan group of economists. And what you can see is that this rolls over in advance of recessions. So these pink zones here are recessions. COVID was a little bit different in that that was a shock-induced recession, so it didn't roll over as clearly as it did before the great financial crisis. However, when you look at what has been going on really since late 21, early 22, it's been pretty miserable. And this is the expression that Ed Yardeni came up with, the so-called rolling recessions, that the economy has taken a lot of hits, not all at the same time, and so we've had different pockets hit different stages of weakness. However, even though this decline has been occurring for more than 4 years, it does start to look like things might be stabilizing here and flattening out. So we're going to be paying a lot of attention to this because this could be potentially the sign of things really starting to turn around and enter into a true expansion and boom that we haven't really had for a long time. One of the reasons why it's possible that this is actually happening now is to look at manufacturing. So manufacturing is a really interesting part of the economy because what you can do is you can go and interview purchasing managers, the people who are making decisions about how much to buy at all the different companies out there that make different products. And when it's above 50, that means things are positive, they're growing. When it's less than 50, things are contracting. And you can see we've been in this period of being below 50 for a long time. But look at just what's happened is just in the last few months, we've entered into this positive, expansive territory above 50. That is exciting and hopefully something that's going to continue and help drive the LEI higher. In addition to that, when you look specifically at one component of manufacturing, which is just new orders, look at this inflection here that we are experiencing just in late 25, early 2026. Very strong, and this is probably due to all kinds of things happening. There's a lot of happening with data centers, with onshoring, with building new supply chains, and so we think this makes sense. And in general, this is something that should feed forward into the economy to help the economy grow. So that's actually pretty positive. And another, I think, great surprise of the year has been that, of course, the Iran war was late February, early March. And normally you think, okay, price of oil goes higher. That means consumers are going to be spending less. There's going to be less action in the economy. People are going to be hiring less. But you know what? The labor market has really defied those expectations. So let me explain to you what's going on in this. I made this graph to show here initial unemployment claims. And this is a powerful leading indicator of the labor markets and actually the economy as a whole. So these data come out every Thursday, and it basically just shows you, okay, how many people are out of work, and they go to the government and they say, hey, I want to file initial unemployment claims. And then the dotted line is just the 4-week moving average, just to smooth out some of the noise of the data. And all this is showing is the percent change from a year ago. And so you can see in general, it's been around zero. But then look at what happened post the war. And there's still a lot of debate from economists about why this is happening. We really don't understand it. But you can see initial unemployment claims are down compared to a year ago, somewhere in that 5 to 10% range. Really interesting that the labor market actually got stronger after the Iran war. And again, we don't really understand why, but it's something that we have consistently seen now for several months, several weeks, I should say. And it's one of the indications that overall the economy and this leading indicator of initial unemployment claims is healthy and strong. This chart here is showing break-even inflations. I did a whole session on this a while ago. If you missed it, hopefully you can watch the recording. Break-evens are the way that the bond market forecasts inflation out over the next 5 years. It's an annualized number that's shown on the y-axis, and it's the bond market's estimate of what this will be over 5 years annualized. And you can see just in the last few months, the bond market has really signaled that inflation expectations are coming down. So even though near-term inflation is going up because of the Iran war, because of higher service costs, higher gasoline, over 5 years it's coming down. That's really encouraging. The market loves low and stable inflation. And again, one of the reasons why the market has been so healthy. Now, I want to make sure to signal risks here. There's always risks in the market. Number one, and I think we're all thinking about this every day with the headlines, are just geopolitical. Is this a quagmire? When is this going to end? When is the Iran war going to end? The strategy is very unclear. It seems like there are early projections were clearly missed. We just don't know how long this is going to go. And so the higher the price of oil is for longer, obviously that depletes especially the low-income consumer and is especially punitive to them. It also really hurts the global economy. I was just in India, and when you go to India, the price of fuel, things like that are very, very significant for so much of the economy, so much of the world, and so this could send the whole world into a slowdown. Fiscal deficits have been a concern for a long time, not just in the United States, but all over the world, so this is something to watch. Higher than expected inflation. There's a huge debate on this. I showed you earlier that the PCE inflation has been higher and growing, grinding higher. And right now, at least people think there's going to be 1 or 2 hikes under Warsh. If that is exceeded, then certainly that would be negative for the market. The other major risks is concerning AI investments. And AI investments, of course, they have been so powerful, and this huge upside surprise that's really carried the economy in ways I don't think many people saw a few years ago. But what if they disappoint? This isn't, I don't think, a base case, but right now these large companies, Amazon, Microsoft, Google, they're spending billions and billions of dollars. And what if their return on investment is lower? Are they going to dial back? In addition, right now, they are spending huge amounts of cash, meaning that their free cash flow is deteriorating. Free cash flow is operating cash minus CapEx. And because their capital expenditures are so high, free cash flow is actually near zero right now for these large companies. And so is that really sustainable? Financing risk. Right now, they're using bonds, they're using off-balance sheet financing, they're using all these creative ways to get money to build these data centers, and there's risk with that. We know that this is a time when companies are just feeling like there's this arms race and everybody's got to be spending to keep up, and so that's kind of a dangerous environment when everybody feels like they have to be spending and borrowing and issuing equity and things like that in order to keep up. So we need to watch that. Okay, what I want to do now is I want to go and do a deeper dive into 2 sectors that I think are especially interesting right now, that you are hearing lots of headlines around, and hopefully we can bring some illumination to that. Let's first talk about IT, information technology. All right, so we've been talking about AI already, and one of the things to know is that AI compute costs have become very punitive. I mean, this is huge. So Uber, the ride-sharing company, they announced in April that they already used their whole budget that they had for the entire year for AI spend in just 4 months. And so they are spending like there's no tomorrow and clearly blowing through their limits. That's not good. Axios reported that one company that wasn't watching it spend in 1 month spent $500 million on Claude tokens, basically just paying Claude for AI spend. $500 million in 1 month. And somebody was basically asleep at the wheel and didn't see how much they were spending. There's been this growing phenomenon where people are noticing that AI is supposed to save money, but then now some people are saying, well, wait a minute, it's actually costing more than the people it replaced, just because when you spend so much on these tokens, this churning of these data centers, it costs a lot of money. And so this is a major issue that is, especially in the last 3 to 4 months, coming to the foreground. Now, the real buzz in July has been around this Kimi K3. So if you haven't heard about Kimi K3, you need to know about it. It's really important, and it's something that's going to affect the whole space of AI and technology. Okay, so what is Kimi K3? So this is from an article that was published in Nature, and Kimi K3 is a Chinese LLM, large language model. So an LLM is something like ChatGPT or Claude or Gemini, something that you type in things and it answers questions and will build spreadsheets, all those kinds of things for you. So it's impressing scientists with its sizing capabilities. And so this was just last week, Beijing, this company called Moonshot AI unveiled this model called Kimi K3, which is a really powerful LLM, large language model, that can handle really big swaths of text. And they found that it can match or outperform rival US models, i.e. Claude, ChatGPT, their best models, on tasks such as coding or manipulating spreadsheets. Not since DeepSeek has a Chinese AI model caused quite so much buzz. It's a turning point, says Joel Pearson, a cognitive neuroscientist at this university in Australia, who studies how AI is affecting people's lives. People are calling it a Sputnik moment. Sputnik was that space race that happened between the US and Russia. 3 days after the model release, Moonshot AI said it had paused new signups to K3 because demand had pushed its system close to the limits of its processing capacity. It's a very impressive model, and no doubt this is going to be really important. Now, I will put a big asterisk around this, which is that there are a lot of people, and in fact, there's some data to suggest that Kimi actually trained itself by studying Claude and ChatGPT. Basically, it kind of cheated, and it used all the work that Anthropic and OpenAI did to advance its training, basically by, they call it model distillation. Okay, so that may or may not be true, but in any case, it's out there now, and it's clearly very, very powerful. Now, why does this matter so much? This matters a lot because of the following reason. Is we need to pay attention to token costs. Okay, so what is a token? You hear this word a lot in AI, but a token you can think of as like the Lego building blocks. They're the components that LLMs work with. And so it can be as simple as a word, cat, or dog. However, a token also can take a word like unbelievable, and it'll break it up into unbelievable. And that can be 3 tokens. And so depending on the word, depending on the nature of the language, it will break up something into the right bite size in order for the algorithm to handle it. And so people are paying on a per token basis. Now, there's a lot going on in this. Sorry, I don't like to have busy charts, but it's really worth paying attention to this. Here, I'm actually going to start on the one on the right. So this is looking at costs per 1 million tokens. And these are all American models here. Okay, so look at Claude. So Claude is, most people believe that the recent Claude models, Fable and Mythos, are the best of the best. And you can see it costs $60 for 1 million tokens to be processed with this latest and greatest Claude model. Okay, there are cheaper models here, and in particular, OpenAI is trying to build cheaper models here, and some of those are highlighted. You can see $7 for 1 million tokens or $18. So they're trying to serve, being mindful of this challenge that I just told you about, that companies are running out of money as they're spending so much money on their tokens. But look over here on the left. These are the costs of these Chinese models. Okay, so this really fancy Kimi model, you can see, is $18 per million tokens. So way cheaper than the Claude models, even though it's very comparable. And then look at DeepSeek. Remember DeepSeek from last January when that really shook the market? So you can see you can do DeepSeek costs for less than $1 per million tokens, 42 cents, right over here. And so this is really important because now you've got optionality. You can pay a lot more for the American models, or you can pay a lot less for the Chinese models. And obviously implications here are going to follow. So you can see a headline here: Microsoft considers replacing ChatGPT and Claude with China's Kimi K3 to save $600 million. That's a lot of money. And hey, they're a corporation, right? They're thinking, just where do I get the same performance for less money? And so this is the kind of decision that companies are going to be making. And you can imagine this is fraught with geopolitical considerations, security considerations, patriotism, all these kinds of things are playing into this now. And there's huge debate. It's going to take a while to resolve this, but really important to follow. Now, we need to talk about Jevons paradox. Some of you know what this is, and if you do, just bear with me for a slide or two. But if you don't, this is one of the most important phenomenon to understand in the world of AI here. So let's go through it. So a common assumption, if you just grab somebody off the street and you say, okay, if we make something more efficient, we're going to use less of it, right? Because it's more efficient. So that makes sense. However, Jevons paradox says the opposite. He was an economist who lived in the 1800s, and he said, if we make something more efficient, it becomes cheaper and more useful, and then people are going to use more and more of it, which then causes total consumption to actually rise paradoxically. Okay, so let's use an example here. Cars. Cars become more fuel efficient over time. And you might think, okay, so that means we're going to be spending less on gas because each mile of driven uses less gas, cars are more efficient, so society uses less gas. However, instead, driving becomes cheaper to, let's say, horses in the early 1900s or whatever other form of transportation. And so then what happens is, because it's now cheaper to drive because it's more efficient relative to a horse, then what happens, more people drive, and then total gas consumption actually goes up. And so you can actually have this effect where more efficiency leads to more usage. And think about it. This has actually been validated time and time again. Think about computer efficiency. So when computers they always are getting more efficient, but when they get more efficient, do we say, oh, they're more efficient, and so that means we're going to have our computers on less of the time because they can do their calculations and they're done, and we can spend less on electricity? No, of course not. What happens is we come up with more things for our computers to do. We figure out how to stream videos and run complicated spreadsheets and things like that. Or the cost of data storage. You might think, oh, data the cost is going down, so we're going to spend less on it. Well, then what happens is people figure out, you know what? Now that it's cheaper, I can store more things. I can have more pictures. I can have videos on my phone, and the next thing you know, more and more people are spending more and more money on all of this data because they can. And so Jevons paradox is almost like a guaranteed in the world of technology. And this is hopefully obvious where I'm going with this, is that when tokens become cheaper, guess what happens? The implications of these lower cost Chinese models there are very profound. These models are likely, going to be more commoditized as more and more people figure out, you know what, whether it's Chinese or American or some other country, if it's cheaper to do it, then why in the world are we going to pay top dollar for the same thing from Anthropic, which makes Claude, or OpenAI, which makes ChatGPT? But here's what also happens is, now that the price of AI falls, more and more people use it. More and more companies are like, hey, we want this. And so that paradox implies that AI usage goes up, and then that drives the need for more inference. And this should actually be really bullish for compute as a whole. And when you think about stocks, you think about infrastructure stocks like semiconductor stocks, memory stocks, networking companies, etc. Okay, so these breakthroughs that have happened, particularly this month in July, I think are quite a strong signal that AI usage is actually going to go up, even though there's a lot of noise. Now, I'm not going to get into the security and geopolitical questions that are difficult to answer. But those are really important. Okay, now this Kimi K3, this model has 2.8 trillion parameters in it. So when they're training this model, they're trying to get 2.8 trillion variables, the numbers all right inside of them. Okay, so that's a lot of numbers. That's a lot of parameters here. And you can see that from this article, people are suddenly realizing, whoa, to do all that, that's going to take a lot of memory because you've got to load up all these 2.8 trillion parameters. That's expensive to have that amount of memory there. Now, I want to explain two terms for you to know. If you don't already know them, they're good to know, and they're going to be coming up more and more in the world of the stock market and AI. The two terms I want you to know are NAND and DRAM. Okay, so if you're not already familiar with them, I'll explain. So NAND is basically a computer's long-term memory. It is slow, but it has large capacity. And when you turn a computer off, that NAND is still there. Okay, so here's some examples of NAND. A USB thumb drive is NAND. The memory on your phone when you record a video or take a picture, that's going into NAND. So if you turn off your phone or if you reboot your phone, it's obviously the pictures are still there. Solid state hard drive. Most of the new hard drives on any laptop are going to be NAND. The next term to know is DRAM, and DRAM is a computer's short-term memory. It's way faster than NAND, but it has less capacity. Here, when you turn your computer off, DRAM goes away. And so the way I want you to think about this is a little bit like, imagine if you have a desk and your papers are spread out and you're kind of working with different documents in real time. That's your DRAM. When you take those documents, bind them up and put them on the shelf for long-term storage, that's NAND. And basically what your computer is doing is it's doing this back and forth between NAND and DRAM, or your phone between NAND and DRAM. Okay, so an example would be Microsoft Word. So you have Microsoft Word on your computer hard drive. And when you click Word, it's going to load it out of NAND into DRAM. You're going to be typing away in your document, editing it, making some beautiful document. And then when you click Save, that document goes into NAND, that long-term storage. And then when you close Word, Word exits DRAM, and it just lives long-term in NAND. And so you can see it's going back and forth. Now, AI, as it turns out, benefits both DRAM and NAND. But where it's especially important is for DRAM, because it's just so active with this like short-term back and forth, juggling all these variables. And DRAM, they, just so you know, they number it, the architecture. The first generation was DDR1, then 2, 3, 4. We're currently at number 5. Okay, on this graph is a really important chart of just looking over time since the year 2000, we're going way back. How much does DRAM cost in US dollars? And it's per gigabyte. And so you can see here, this blue line is how much it costs for 0.064 gigabytes back in 2000, 2001. And you can see the price went up for a little bit, and then there's a build, and then they make too much capacity, and then, woo, prices go down. And then here they made the next gen that has a little bit more memory, and you can see prices fell. Normally it has this kind of up and down pattern here. And you can see in general, this is not a great market to be in. It just kind of has this like up and down, and it's been pretty miserable pricing. However, look at what has happened since 2025. You can see that this DDR5, this 5th generation, has gone like vertical, and it has exceeded this $10 ceiling that previously DRAM has not ever exceeded before. In fact, it's actually more dramatic than this because the graph is cut off. This is showing the true graph, and just since 2023, so you can see it was about $5 for a long time in 23, 24, and 25. And then look what happened in the third quarter of 25. Isn't this wild? It just shot up the price to now to be around $40. So about an 8-fold increase in price. And this is all because these models are so hungry for this DRAM and they're just eating it up. And so this is one of the reasons why in the last quarter and really this year, we've seen the broadening of the AI trade. It used to be NVIDIA and the Mag 7. But if you follow the market, you're seeing these memory companies, companies like Micron and Samsung, Korean company, go up and up and up as these prices go up as well. And so this is a huge story of the market, this broadening out beyond the Mag 7, beyond NVIDIA, into these smaller companies that historically have been more cyclical, but now all of a sudden people are wondering, like, are these models going to keep needing more memory? Now, I want to highlight that there are risks here. There's always the risk of local opposition to data centers, and this has been growing over time. This is an article that highlights that at least $156 billion across 48 projects with publicly disclosed values was blocked or stalled amid coordinated local opposition in 2025. Public opinion has really turned against data centers. People are saying it's going to make my electricity bill higher, it's going to take more water, it's going to ruin our communities. Those might be debatable points. However, that's at least sentiment. And so this is something worth watching. And if we look specifically at a quarter-by-quarter basis, how many projects have been blocked or delayed? The darker red on the bottom is how many projects have been blocked. And you can see what it was the first half of 25, second quarter of 25, and then you can see 1Q26 is the highest ever quarter. So people are really turning here. And so this is also something we're going to have to watch very carefully. Okay, last sector is healthcare, and I am excited. I used to see cancer patients when I was a physician, and I can't tell you how utterly thrilled I am about what's going on in healthcare. Before getting to some advances in cancer, I want to say M&A has been absolutely incredible. We've talked about this a lot. It's been very strong in 2026. If you annualize where we are so far, it'll be the second best year of all time. And so that's consistent with what we said before. These big companies are losing products due to patent expirations, and so they've got to acquire the small companies. So here it is, and I think this is one of the reasons why healthcare, biotech has done well in 25 and in 26. I just want to point this out because you've got to be somewhat of a contrarian to succeed in investing. Even though biotech has done really well, medtech, those are the companies that make the hardware, things like heart valves or defibrillators or products for the spine, all of these kinds of things. Those companies have actually sold off and are basically at 20-year lows relative to the S&P 500. For whatever reason, people have treated this space as being losers in this AI-rich world. And in general, I think there's been a lot of throwing out the baby with the bathwater. I think this is a great industry to watch to resume an upturn. I'll also point out that even if you compare it not to the S&P 500, but the Russell 2000, if you look on an enterprise value to sales, basically price to sales, huge divergence. In the orange is the Russell 2000, the enterprise value to sales. And look at that fork. What in the world is going on here? Where this is trading like a broken industry. It's not broken. It's really healthy. There's a lot of innovation and exciting things happening. And again, this is an area to be watching. Okay, so get ready for this. I think this is easily the most exciting story of 2026 in biotech. It's a cancer breakthrough. And specifically, it involves one of the deadliest cancers, which is metastatic pancreatic cancer. One of the reasons why it's so deadly is that your pancreas is so deep in your abdomen that you can't really feel it. And by the time somebody experiences symptoms, it's usually metastatic. It's gone to other parts of the body. And so patients who have metastatic pancreatic cancer have less than a 5% chance to live 5 years. Median survival is around 6 months. It's a real terrible cancer, often called the death sentence. It has been known for decades that 90% of pancreatic cancer patients have a mutation in a gene called RAS. Okay, RAS happens to stand for rat sarcoma. It was first discovered in rats, this tumor that was there called a sarcoma. However, humans have the same gene, RAS. It's the common to humans and rats and other mammals. And as it turns out, it's been just known to be a driver and really, really significant for pancreatic cancer. However, despite that, we haven't made much progress. Let me explain why. And before giving you the full explanation, I'm just going to give you a quick primer on RAS. And hopefully this is an opportunity to appreciate the beauty of our bodies and our cells and the design that we have. Okay, so in general, when you look at a cell, there's a cell membrane here. And then this here that looks a little bit like a Y or something like almost like a cup is a receptor. And what it does is it holds on to growth factors that are swimming around outside of the cell. And so there's all these growth factors. There's insulin-like growth factor. There is vascular growth factors that tell blood vessels to grow. There's epidermal growth factors that tell skin cells to grow. There's all these different growth factors. And what happens is the growth factor binds to the receptor, and then it talks to, there it is, there's RAS. And RAS is a switch. And basically the receptor gets turned on, it tells RAS, turn on. And RAS turns on for a little bit, usually a second or two, maybe a few seconds. And in that burst of being on, it turns on other proteins that then tell the cell to divide. And so it says, grow, get bigger, multiply, all those good things. And so that's how growth factors work, right? So they're on the outside of the cell, and there's this signal that gets transmitted through the cytoplasm to the nucleus that says, grow. Okay, so that's what normally happens. What happens in cancer? What happens in cancer is that RAS gets mutated so that it's permanently on. I told you before, it's normally on just for a few seconds. If it's permanently on, it's just saying, divide, 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 grow, 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 don't stop, don't stop. And then what happens is the cell just goes at it, and it just grows and grows and grows in an uncontrolled manner. And so, again, this has been known for a long time, that there's this mutation that exists, not just in pancreatic cancer, by the way. It's the most common mutation in all cancers. However, 90% of pancreatic cancers have it. Okay, so this biology has been known, and it's been so frustrating because RAS has been put in this category called undruggable. What does undruggable mean? Undruggable means that basically scientists haven't been able to develop a drug that turns it off, because I told you it's in this perpetual on state. And the way to think about this is RAS lacks pockets that a medicine could slide into to turn off the switch. And so one way to think about when you design a drug, it's a little bit like climbing a wall. So if you've ever done any rock climbing or anything like that, you know if you're climbing a rock, you look for like a groove or some kind of a crack or a hole in the rock to put your foot in. And you need some kind of a foothold in order to scale it. But if you're climbing just sheer glass, smooth glass, good luck. Never going to happen, right? We need some kind of a grip there. And so what drug designers do is they look for some kind of a pocket or a groove or a crack in the protein where they can slide a medicine in order to turn it off. And people had just not been able to do that for, like I said, decades. Now, I wish I had a whole hour to talk about this. We don't, so I'll have to give only one slide to it. Basically, what happened was a professor from UCSF found a little crack in the molecule using some very sophisticated structural biology. And even that crack was kind of small and not sufficient to grab a hold of the protein and turn it off. And so a company said, you know what, we're going to design what's called a molecular glue. And we're going to get not just a molecule inside of this crack, but that molecule is going to drag a whole other protein called cyclophilin. And basically this giant complex is going to now shut down RAS. Okay, so it's really interesting because normally medicines they go in a singular manner to bind to a protein. This medicine is actually bringing a whole other protein and making this triple complex of RAS on top in purple. Here's the medicine, and then here's another protein that's being dragged along just to really shut it off because it's such a pesky protein that needs some extra mass to shut it off. Okay, so here's where it gets exciting. This was just published in May of this year. Using that drug that I just showed you doubles survival. Okay, amazing. So here what this is showing is they took about 500 patients and they randomized them to either chemotherapy, which is standard of care for pancreatic cancer. And what this is showing here is time on the x-axis. This is months. And then this is the percentage of patients alive. So at the beginning, 100% of patients are alive. And then sadly, as time goes on, you can see every tick down is a patient dying. And what they do is they measure when does it cross that 50% line. And so you can see here at 6.7 months, 50% of the patients have died on chemotherapy. When does it cross the 50% line on this new molecular glue approach? Well, you can see it's 13.2 months. So it's almost exactly a double here. Whoa, you hardly ever see this in cancer. Like I said, I used to treat cancer patients many years ago, and this is a true breakthrough. This got a standing ovation at this year's American Society for Clinical Oncology in Chicago, and a total breakthrough, incredibly exciting. And now that scientists have this, you better believe they're going to improve and make it better and better. And so this is, like I said, one of the deadliest cancers out there, and it should give us hope, not just for pancreatic cancer, but for many other cancers as well. And wouldn't it be amazing if 30, 40, 50 years from now, cancer was a thing of the past? That's my hope. Okay, so in conclusion, the S&P 500 has done well year to date. Why? Earnings, earnings, earnings. This has been just a very strong earnings story in terms of individual companies that are growing. I showed you 15, 20% year over year in terms of profits. Inflation's been high. Okay, so we gotta own that. We gotta face that directly and say, okay, that explains why we have this higher 10-year yield. And it also explains some of this tough talk from the new Fed chair, Kevin Warsh. I don't blame him. You know, he's got to come out and show that he's not going to just let this go uncontrolled. That can be a self-fulfilling prophecy if people believe that inflation is going to keep going. Now, the three legs of the stool, let's aggregate them and sum them up here. Sentiment, neutral to positive on equities, which again is a contrarian negative. We don't like it when people are excited about equities. So we're going to score this as neutral to slightly unfavorable. Valuation is rich of the S&P 500. I showed you those data, but it looks a lot better when you go down cap to mid and small. The leading indicators are starting to look encouraging. Manufacturing, the LEI, some of these labor indicators, we'll continue watching those. But the really good news is there's low correlations. And so if you can do good security selection, that should afford opportunities. Regarding AI, I think the developments, particularly of this month of July, they mean more long-term computational power demand. And there's going to be some losers here, of course, but in general, if you're an infrastructure provider, if you're kind of making the shovels and the pickaxes and all those things, you're going to do well, we think. This has broadened out the AI trade. I gave that example of memory. And as I told you, I am most excited about just the brilliance of all of these scientists and physicians who have doubled survival in metastatic pancreatic cancer. And this is going to get rolled out to more and more cancers. And I think this signals the promise of biotech for many years to come. We love investing in this space here. We think it's one of the best spaces to promote human flourishing here. So with that, I'm going to let Fred make a few announcements, and then we'll do questions.
Thank you, Finney. Exciting as always. And thank you all who are attending this call. Before we get to the questions, I want to take a moment to talk to you about something we're really excited about, the Eventide Advisor Center. So no matter where you're at in your faith-based investing journey, whether you're just getting started or you've been doing this for years, the Advisor Center is built to help you grow your practice and differentiate yourself through a faith-based lens. So what does that actually look like? I want to walk you through a few of the key features. First, practice management content. Access presentations and resources you can use with your clients to educate them and engage on the topic of faith-based investing. Second, screening results you can share. Screen your clients' portfolios for exposure to harmful products and practices, and share the results to demonstrate the impact of their investments. And third, portfolio building. The Advisor Center gives you comprehensive tools to build out full portfolios, evaluate for harmful exposures, compare holdings, and identify companies contributing to human flourishing. And that last point is really the whole idea behind this tool. Because when you're not buried in building portfolios from scratch, you get more time back for what actually matters, your relationship with your clients. You can sign up today by scanning the QR code here to be the first to know when the Advisor Center is available. And thank you, Finney. We have a few more announcements right after this regarding upcoming webinars. The first is an Eventide mid-cap growth portfolio review to be hosted by you, Finney, actually, on September 3rd. So you can scan the QR code here and register. We'll look forward to see you attending. The next webinar is a practice management webinar created by Eventide. It's a motivational speaker named Blake Brewer. He unfortunately lost his father when he was 19, but at the same time received a letter from his father written beforehand. Blake is called to inspire fathers to be great fathers to their families and leave a lasting legacy to the people that they love. So we invite you to join this Legacy Letter seminar on September 16th at between 3 and 4 p.m. Eastern Time. The last webinar is a client event preview called The Power to Choose, hosted by Eventide's co-founder Jason Meyer. This presentation walks through real examples of two different sources of return: profits from companies doing good and profits from companies causing harm. It is a challenging presentation, and I think you'll be delighted to attend and learn from it. Okay, great. So we do have time for a few questions that we have received as a follow-up. So let's start out with the first one. Finney, we talked a lot about AI. It is a fascinating space. On the macro level, what role does the U.S. play on the global stage regarding AI?
Yeah, the U.S. is clearly the leaders in AI. So the initial breakthroughs happened particularly with the so-called transformer models. That's the T in ChatGPT. Those were published by Google. Anthropic is a U.S. company. OpenAI is a U.S. company. NVIDIA is a U.S. company. So, the real heavyweights have been in the U.S. However, it is certainly a global ecosystem. NVIDIA, for example, is a so-called fabless company. They don't actually make their chips. Most of that happens in Taiwan at a company called TSMC. There are these memory companies. It's really an oligopoly. There's three companies: Micron, Samsung, and SK Hynix. And the latter, SK Hynix and Samsung, are Korean companies. So we have this interesting arrangement right now where a lot of the hardware is made outside of the U.S. Some of that will change. It takes a long time to build these fabs. If you follow Elon Musk, this so-called terafab, that's going to be built probably in the next few years. That will lead to more U.S. production. TSMC starting to build in Arizona. And so there is more manufacturing happening in the U.S. So I would say, generally speaking, the division is a lot of the creative thought leadership tends to happen in the U.S. A lot of the manufacturing tends to happen outside of the U.S. But certainly Trump, the CHIPS Act under Biden, they're trying to get more and more of that manufacturing to happen on U.S. soil. I think it's really important to not underestimate the global dynamics here, particularly China. China is making gestures that they are going to be developing more memory right there in China. That's certainly something to watch. Obviously, we talked about these models, these open weight and open source models coming from China. Those have tended to be lagging, and they tend to be, in some ways, copying some of the innovations that happen here. But who knows? Could that change? Absolutely, it could. So I would say, currently a place of leadership, but it's not an ironclad position. It's certainly going to require a lot more investment in order to stay abreast of this rapidly changing field.
Thank you, Vinny. Do you believe that AI spending will turn into real profit, or just more infrastructure spending?
Yeah, that's the really multi-billion, multi-trillion-dollar question is, what is the ROI here? And we really don't know. It's way too early to say. We know that there's early signs of it being uneven. Let's put it like that. So the poster child on the negative side would be Oracle. Oracle is spending more than they're taking in, and many of you have probably seen their debt was recently downgraded to one level above junk bond status because they're just having to issue so much debt. However, there are companies that seem to be monetizing it reasonably well. I think Google's doing, a very interesting job with integrating Gemini into their own workflow. Probably everybody here is seeing, when you type a Google search, how Gemini is now being tied in. I think the real monetization has not even begun to happen yet, and it will be the scenario where you go into your LLM or your agent and you say, I want to buy a new shirt, or I want to go on vacation to Spain, and it will then say, okay, here's what I'm recommending. Would you like me to book the tickets for you? Would you like me to make the reservation for the hotel? Would you like me to get tickets here? And then, of course, it'll take a small cut of all that. And so when AI really integrates well with commerce, I think that's going to be very interesting. But right now, people have to spend in order to get to the place where people are just going there to ask questions and engage. So yeah, it's very early to say. And I think, these big companies know that unless they make those investments, they're just out of the game, and they're never going to even be able to compete in that race for that, especially agentic commerce. So I'd say the jury's still out, and early signs of a lot of divergence and complexity.
Thank you, Vinny. I think I definitely want to sell shovels and pickaxes
That's right.
in industries such as this one. Let's go back to biotech for the last question. As we are seeing some high-level changes at the FDA, what are the impacts? Do you believe they're accommodative to the industry?
Yeah, we didn't have time to talk too much about that. I wish we did. So the former FDA Commissioner, Marty Makary, was let go, and we have an interim commissioner now, Kyle DeMonis, who's there. And I would say the consensus certainly is that it's positive. There's a consortium of companies called Bio, and they put out a statement saying that they like the changes that they've seen in this new regulatory regime. And just to maybe give one example of this, there's a company that is developing a medicine for Huntington's disease, had really interesting data, and the stock did well. The whole Huntington's community was so excited. And then the FDA, under the previous leadership, came out and said, we want you to do a randomized study where some people get a sham surgery. So this particular therapy involved a brain surgery where you would have a gene therapy put into a certain region of the brain where there's deficiencies in Huntington's. And that was not on the table before, and to get that kind of last-minute regulatory surprise is not normally acceptable or very courteous to people who are making these kind of huge decisions around how to design their trials. But then, under the new administration, they said, you know what, we're actually going to consider your original data package. And so they've been going back and I think helping to restore some trust that there's known rules and a known interaction pathway with the FDA, and they're not going to get thrown a curveball or some surprise at the 11th hour. And so that's really positive. And I think particularly more discipline around communication, where communication comes from official channels, not from a podcast or somebody making an offhanded comment in an article. and being more careful about some of that. And so in general, I think that's really healthy. A lot of staff were lost under Doge, and so it's going to take a while to rebuild some of that. And in general, approval times have lagged somewhat. So there's a ways to go, but I think overall the trends are heading in the right direction.
Thank you, Finney. And we haven't even covered China's innovation in biotech
No,
on
we
this call
haven't.
this time. We can try that for the next time.
All right.
So, yes, thank you so much, Finney, and thank you everyone for joining. We hope you leave this call better informed of both market dynamics and Eventide's views as we seek to store your assets faithfully. We hope to see you all again next quarter. Thank you.